I have made millions of dollars trading options using this particular strategy. And in today's video, I'm going to be breaking down exactly how to use what I believe to be the most powerful tool in options, and that is LEAPS options. Now, if done right, LEAPS options can generate massive returns. I'm talking 5x, 10x returns, but with defined risk. So we're going to go through everything step by step, and at the end of this video, I am going to go over my own personal strategy of how I was able to generate these returns, so hopefully you can apply them to your investing. Now, what are LEAPS? Well, LEAPS actually stands for something. Now, if we take a look, the acronym stands for Long-Term Equity Anticipation Securities. So I guess without the T, you get LEAPS. Now, this is just a fancy term for the following. So the definition of LEAPS: option contracts, now they could be calls or puts, that have an expiration date of 12 months or more, okay? So it could either be calls or puts, and they're just option contracts, but here's the most important thing. The expiration date is 1 year or more, right? So it could be 1 year, 2 year, 3 years out. And this is going to be the basis of our whole strategy, that expiration date and the benefits that it gives us. Now, in this video, we're mainly going to focus on buying call options with a long-term expiration date. So when you buy these LEAP call options, you are paying for the right to buy stock at a set price, but instead of the option expiring in a few weeks or a month, like with typical option contracts with short-dated expirations, LEAPS give you that right for a much longer period. Now, this makes LEAPS especially useful for long-term investors who want to benefit from the upside of a stock without having to put up a lot of capital and with limited downside risk, okay? So all those pieces of the puzzle will be put together to ultimately understand LEAPS. Now, like I said, we're going to focus on buying call options with long-dated expiration. So we have to quickly understand what a call option is. A call option gives the buyer the right, but not the obligation, to buy stock at a specific strike price on or before the expiration date. So let's create a scenario. You watching this, let's say, own a stock. And let's say that stock is trading at $100. Well, if I buy a call option, I am saying that I want the right, if I wanted to buy your stock at, let's say, $105 sometime in the future. Now, why would I do that? Well, let's say I think that the stock is going to trade up to $120, so I want to lock in the price of $105 now. So even if the stock goes up past $105, I still have the call option that says that I can buy your stock at $105, right? I can buy the stock at $105 and then sell it at $120 if that's what it's trading at, as an example. Now, you are on the other side of the trade, and maybe you think that the stock will not reach $105 by the expiration date. Well, you can sell me that call option. Now, for me to buy this call option from you, I have to pay a premium to the seller. I have to pay you a premium. So let's say I pay you $2 per contract. You would then collect that premium for taking on the obligation of selling that stock at potentially a lower price to me. Now, here's what happens. If the stock does trade past your strike price of $105, then the contract that I bought would be worth more money because it has more value than it did before, because I can buy the stock at a lower price and sell it for higher. Now, in most cases, to profit off this trade, you can just sell the option contract instead of actually buying the stock. So you are profiting off the appreciation of the option contract itself. Now, that's the key here. You want to be able to buy the call option, have the stock go up, and then sell the call option for more money. But here's the problem with buying options. You are constantly working against time. Because remember, every option contract has an expiration date. So if you have an option contract with a short-term expiration date, then it doesn't give your trade enough time to hit its target. Short-term market swings are pretty much unpredictable, and this is where LEAPS come in. With LEAPS, we are extending the expiration date to 1 year or more for us to have a better chance of success. Now, besides the obvious time advantage that we have, why would somebody want to use LEAPS? Well, there are a few reasons, so let's go over them. So the first is obviously time. Time is on your side when using LEAPS because we have more of a chance of success when we spread out the trade for a longer period. Now, LEAPS also lowers your cost basis, right? So it lowers cost basis. And we're going to go over an example of this, but just know that you are putting up less money by buying LEAP options than you would by buying the stock outright. Now, you can make more return on investment. So more ROI on your investment. So basically, a simple way to think about this is that if your stock appreciates a certain amount, the LEAPS option contracts will appreciate more than the stock. Next, you're going to have with LEAPS options the right to buy stock at a lower price. Okay. So because we're entering a contract and we don't know exactly what the price is going to be, we have then the potential of buying that stock after it has appreciated, locked in with a lower price. Okay. You also have defined risk. So defined risk means you know exactly how much you can lose on this investment. And basically the defined risk comes down to the premium that you paid. If you pay the premium to buy the option contract, that is the most that you can lose on this trade. So your risk is defined. You know what it's going to be, worst case scenario. And the last reason somebody might want to use LEAPS is to hedge. So hedging position. Now, hedging your portfolio with LEAPS you can do in a few ways. So let's say you have a stock portfolio and you want to protect against the downside. If you think that, oh, the stock has gone up too much, might come down, then you can protect it by buying LEAPS. Now, you don't know when it's going to come down. So you just buy a small percentage of your portfolio in put option LEAPS, for example. So if the stock does come down, you can profit or at least minimize your loss on the stock. So as you can see, we have a lot of benefits. We have the time that it takes for our option to expire. You have a lower cost basis, so that will reduce the amount of capital that you have to put up. You can make more return on your investment. So even though you're using less money, you are making overall a larger return percentage wise. You're going to have the ability to buy the stock at a lower price. You have defined risk and you have the opportunity to use this as a hedging tool in case you want to. Now, of course, with these benefits comes some trade-offs as well, right? Now, if you were just owning the stock rather than the LEAPS options, you have a few benefits of that as well versus the options. The first is you do not get any dividends, right? So no dividends on your LEAPS options. See, when you're buying stock and it pays a dividend, well, if you're buying the LEAPS options, you're not actually owning the stock. So, of course, you don't get any dividends. The second way that they're not like stocks is, well, options expire, right? So options expire even with long dated options, they will expire at some point. So if you are a long-term investor and you really like a stock and you want to hold it for, 5, 10, 20 years, then of course LEAPS options can help you a little bit, but it might take away from your ultimate goal of just owning the stock outright. The third way that they're not like stocks is that they lose value to theta, okay? So they lose value to a thing called theta. So what is theta? Well, theta is part of the Greeks. You have theta, delta, gamma, all that kind of stuff that you look up on the option chain and you're like, I don't know what's going on. But I think it's important to understand at least a few of these theta, and we're going to get to delta in a bit. But theta is the amount that the option contract loses in value with each day that goes by. So basically, you could think of it like this. Once you buy the option contract, it naturally decays, right? The price of the option naturally will go down from the time that you buy the option contract to the expiration date if nothing else changes, right? Because theta eats away at this option price. So let's go over an example. So let's say the premium that you paid for an option contract is $2. Okay, $2. So with a $2 option contract, you're actually paying $200 because one option contract controls 100 shares of the company. But if you take a look at the option price, it's going to say $2 per contract. Now let's say theta, right? Theta in this case is going to be 0.50. All right. That means that for every day that goes by, you're going to lose from this contract 50 cents, right? So the new option price after a day is going to be $1.50. Now, this is an exaggerated example with a pretty high theta. This probably means that the expiration date is quite short, because the shorter the expiration date, the more theta will decay your option. And the longer your expiration date is, the smaller the theta is because you have more time to expiration. So this is a good way to understand that options lose value over time. So to take advantage of this as much as we can, we want options that expire with a longer time frame. That means the theta decay is slower, which ultimately means that the option contract doesn't lose as much value as quickly. All right, now let's talk about the return on investment and the difference between the stocks and the options so you could understand why you are using less capital but making more money. So let's create a scenario. Let's say that you bought a stock. Okay, so this is your stock right here, and you paid $10,000 to own that stock. All right, so that is the capital that you put up, $10,000 to buy the stock. Now, let's say that the stock cost you $100 per share. Okay, so it's trading at $100, and we had a good run with the stock, and now all of a sudden, instead of 100, it goes up to $110. Well, I'm sure you could do the math on this. This will equal a 10% gain or profit, right? So 10% profit in your stock appreciation. Now let's take a look at the options, right? So let's create another scenario now with buying options. So your options play is as follows. You buy a call option on the same stock, and let's say you pay $2,500 in premium to control 100 shares of the company. Okay, so 100 shares of options, and then this is 100 shares of the stock. So the price per option would have been $25, right? Because 25 times 100 is 2,500 that you pay for the premium. You're paying $25 per contract. So let's say that the stock goes up. Well, your option will go up as well. So let's say from 25, it goes to $35, right? So now each option contract is worth $35. So now you can sell that contract for $35 times 100, which is 3,500, minus the $2,500 that you spent in premium. You have a gain of $1,000, right? $1,000. But here's the thing. This $1,000 relative to your 2,500 that you put up is actually a 40% gain, right? So 40% gain or profit on this trade. So you put up a certain amount of money, you made 40% on that money. Relative to the stock goes up, you make a 10% profit, but you had to put in more capital to begin with, all right? So we've checked off a few things that would make buying the options a little bit more enticing, right? So you get more profit on a percentage basis, and you have to put up less capital to control the same amount of stock that you would if you bought it. So pretty good. But you know what most traders don't think about? Those small regulatory fees that stack up every time that you open and close a trade, especially if you're trading options. That's why I've been using Public, the only brokerage that I've seen that actually gives you a rebate when you trade stock and ETF options. You can earn up to 18 cents per stock and ETF contract, and there are no commissions or per contract fees on those particular options. So instead of paying to trade, you're actually earning a bit back. For example, I earned 12 cents on a recent option trade on Apple, a 6-cent rebate when I opened the trade, and a 6-cent rebate when I closed it, which is really unique and helpful when trading options. One thing I really like is the options strategy builder that helps you plan your trade. So whether you're trading 5 contracts or 500, Public is one of the most straightforward and cost-effective places to trade options right now. Now, Public is not just for options. You can trade stocks, crypto, bonds. They even have corporate bonds, which is super interesting. So you can build a multi-asset portfolio all in one place. Check them out using the link in the description. Thank you to Public for sponsoring this part of the video. And now let's get back to Leaps. So now that we understand the return on investment, your actual return is going to be dependent on the type of option contract that you buy, whether you bought in the money options or out of the money options. All right, I want to jump into the actual option chain to show you the in the money and the out of the money options so we could understand what we're working with. All right, so open up any trading app that you want. I am using Public. I love this app. I'm going to go trade and trade options just like this. And you're going to see the option chain pop up. Now, the option chain has a lot of things, right? It has the current stock price, the premium over here. This is how much the contracts cost. And of course, the strike prices on the left. You have the expiration dates on top. And here you can go buy and call. Make sure that you are on the right trade. In this case, we're going to want to buy a call. Now, for buying calls, you notice that the stock price of Apple right now is $196. So the strike prices are as follows. Anything that is below the current stock price, which is 196, so 195, 192, 190, 187, all of these prices that are below all these strike prices, they are in the money options, okay? This essentially means that the stock price has already surpassed whatever the strike price is, right? So if the strike price is $180, well, we're in the money because the price of the stock is currently higher. Okay. Now going up, and you're going to see out of the money options. Now, out of the money options are prices that are above the current stock price. Now, remember, when buying call options, you want the stock to go up. So you want the $196 to go up to 197, to 200, to 202, but they haven't reached there yet, right? And that's why we call these out of the money options. Okay. So if we scroll up, you can see all of the out of the money options: 197, 200, 202, 205, 207, so on and so forth up the option chain for the out of the money options, okay? So that breaks it down to understand that if you're buying in the money options, it's going to be different than out of the money options. And why is that? Well, the answer to that is pretty straightforward. See, when you have an option that is in the money, that means the stock price has already hit the target price and it is now above it, then it has intrinsic value. That means that you can now buy the shares for a lower price and sell it for a higher price. So that has value. Now, with out of the money options, again, the stock price has not reached those strike prices yet. So currently, if you were to exercise your option, well, then you would be buying a stock at a higher price and then selling it on the open market for a lower price. So that doesn't make much sense. So that's why there is less value in the out of the money options, because the chances that it will get in the money are less. Now, when thinking about this in profit terms, you would have to pay more to buy in the money options because, again, it has value, but the profit would be less than if you were to buy out of the money options, which are cheaper. But the potential, if the stock does reach that strike price, would be more. Now, to understand this fully and to make the best decision possible on what type of LEAPS options that we want to buy, we have to understand delta. So what is delta? Well, delta is the number that tells you how much an option's price is expected to move when the underlying stock moves by $1. So you have the stock price and you have the option contract price. Well, if that stock moves up or down by $1, what does that mean for our option contract price? Well, the delta is going to tell you how much that's going to move relative to the stock. So if the stock goes up $1, the option contract will go up by the delta amount or go down by the delta amount. So let's break this down right here. Now, for call options, we are going to have a delta between 0 and 1, okay? So 0 is going to be on this end and 1 is going to be on this end. Now for puts, the delta is going to go from 0 to -1, so you'll see a negative number on the put side of this, but because we're concentrating on the call options, we're going to take a look at deltas that go from 0 to 1. Now, one important thing to understand is that all the deltas of all the options will be between 0 and 1. You're not going to actually see an option with a delta of 0 or a delta of 1 because this is what happens at expiration. Now, if the contract is in the money, then you're going to have a delta that's going to finish with 1. Okay. If an option expires out of the money, that means it has no intrinsic value, then it's going to have a delta of 0 at the end of the contract. All right, so let's say here's your midpoint here of 0.5, and typically you would get something like this. The further in the money an option is, the more it's going to trend towards that 1 delta, okay? The further out it is out of the money, the more it's going to trend to the 0, okay? So out of the money is this way, and more in the money goes towards 1. So let's say you have a delta of here 0.6, okay, or 0.60, 0.612983, whatever you see on the option chain, you're going to have this delta to work with. So this means that for every $1 that the stock moves, your option contract will increase by 60 cents, okay? So let's say that you have a stock that is $100 and it goes up to 101, all right? Then the option contract, let's say your option, say the contract price is $5 per contract. Well, that means that if the stock goes from 100 to $101, your option is now going to be worth $5.60 because it goes up by zero point 0.6. Now, the further down you get in the money, closer to that one delta, so zero point 0.8, zero point 0.9, the closer it's going to resemble holding the stock itself. Because a delta of close to 1, or let's just call it 1 for this example, would be equivalent to a $1 stock movement. So if the stock goes up $1, then the option will go up $1. So a strategy using this concept might be as follows. Let's say you want to buy 100 shares of a company, but you don't want to buy 100 shares because the capital you would have to put up would be too much. So instead, you buy in the money LEAP options with a delta close to 1 as possible. This is going to trade like the stock. So if you have a certain percentage dollar term gains in the stock, that's the same amount of gains that you are going to have in the options. But again, just like in this example, the percentage based off of the capital will be more. The dollar terms are the same, but you had to put up less capital to do so, which is a bonus. Now, another interesting thing about delta is that it could be used to estimate the probability that your option will expire in the money. And this is the goal of all option contracts when you're buying options, especially LEAPS. You want that option contract to finish in the money. Now, again, what that means is that the stock price is above the strike price so that you can buy the stock at a lower price and sell it for a higher price. So we can use the delta number to estimate what is the likelihood of this happening? What is the probability? So again, if you have a delta of 6, that means that the likelihood or the probability that this option will expire in the money, which is what we want, is around 60%. Now, again, this is just an estimate. Same thing happens if you have a zero point 0.3 delta, right? If you're going out of the money and you pick a delta with a zero point 0.3, that means that you have about a 30% chance that that option will then become in the money and be worth something. So a zero point 0.3 delta, about 30% chance, zero point 0.6 delta, about 60% chance. And right here in the middle, you have 5, which is about at the money. So if you take a look at the money options, they're going to be around 0.5. Okay, there's a 50-50 chance of which way the stock will go. And therefore, that means that there's a 50-50 chance that it will either expire in the money or out of the money. So delta also gives you the probability of in the money options at the end of expiration. So now you understand how you can use delta for your own risk reward in the investing that you want to do. So if you want to play it safe, you could buy in the money options with a delta that is closer to 1. That means that you're putting up less capital, but you're going to get the same appreciation that you would have if you bought the stock. Now, if you want to take a little bit more risk, you can buy out of the money call options. If you think that the stock will reach that strike price and then surpass it, then you're looking at a delta of maybe, let's say, zero point 0.3. But again, that has its trade-offs because even though you're purchasing that option that is out of the money in hopes to make a greater return, we now understand that a zero point 0.3 delta means you have about a 30% chance for that option to expire in the money. So it's really a balancing act of the amount of risk that you want to take on versus the amount of reward that you want to get. So now we can put it all together and go step by step through your sort of plan of attack when going into a LEAPS options trade. So the first thing that you want to do is select a stock. This seems obvious. So you're going to look for a stock that you want to buy that, again, you think is going to go up in the future, right? When you're buying call options, you want the price of the stock to go up. So you're going to select the stock based off of whatever sort of research that you do, fundamental, technical, whatever the case may be, you think that stock will go up. So that's the stock we're going to go with, all right? You have your stock. Now, the second thing that you want to do is you want to really create your why. So what is the reason of you using LEAPS for this particular trade, okay? So why LEAPS? This is important to define out because you have a bunch of different reasons why you could have used LEAPS, right? You have, oh, because I just want the time on my side, lower cost basis, more return, could be a combination of a lot of these, but really define this out because this is going to help you in your strategy when understanding profit and loss, when understanding do I have too much risk on when I should close this trade? All those kind of questions that you might have after you put on an option trade can be answered by simply understanding your why ahead of time. The next thing that you're going to do is look for the appropriate expiration date and strike price, right? So of course the expiration date is at least 1 year out, if not 2 years out. I like to go as far out as possible because I really want that trade in my favor as far as time. And the strike price, again, you have to do that risk reward. Do you want to buy in the money options, at the money options, out of the money options? Now, typically, you can substitute the stock purchase within the money options because worst case scenario, you have a good chance of that option expiring in the money. But if you go out of the money options, you might want to take a smaller percentage of your portfolio, because if that has a 30% chance of expiring out of the money and you lose your whole premium, well, you don't want to go in with all of it, right? I'm all in out of the money options and then you lose it all. Well, then what are we doing here? So that's going to be the next thing is determine the percentage of portfolio. All right. How much percentage of your portfolio are you risking on this trade? And that is again going to be dependent if you're going in the money, out of the money. But typically, you have to understand that if you have an option contract and let's say you go out of the money with it, right? Well, I'm going to take maybe 10% of my portfolio. That might be actually a lot. So let's say 5% of my portfolio. If I take 5% of my portfolio and I put it into an option trade that could 5x or 10x, then that 5% that you invested could actually turn into a quite substantial gain on your overall stock portfolio. Okay. So a very simple example here would be, let's say 10% to make it easy to follow. You have $10,000 and you take 10%, which is $1,000, and you put it into LEAP options contract and you hit the jackpot. You get 10x return on your investment. You put up $1,000 and now it's worth $10,000. Well, your overall now portfolio has doubled in value. You went from 10,000 to now having 10,000 more. So with a 10% risk, you're getting a 100% reward on your overall portfolio. So this kind of trade is an asymmetric bet. You are betting a small amount to make a large amount. And now the last thing is you're going to want to check your delta, okay? Again, delta is very important because this is going to tell you the option's chance of becoming in the money, out of the money, and also it's going to tell you how much relative to the stock your option will move. So let's create a scenario. Let's say you bought an option that was in the money, pretty safe, let's say at a delta of zero point 0.7, but the stock goes down. Now, what's going to happen? If that option now becomes out of the money because the stock dropped so much, then your delta is also going to fall, right? So it adjusts with the stock movement. You're going to want to check that delta of your option because if it gets to a zero point 0.3 delta, let's say, and you have a 30% chance of that expiring in the money, then you might want to think about either cutting your losses or rolling your position or something like that. If, on the other hand, you bought a delta that is out of the money and then it becomes in the money, you'll notice that the delta now is a higher number. So you can see that, oh, now I have a 70% chance this is going to expire in the money. Oh, I have an 80%, 90% chance. Your delta will give you an estimate of how your trade is doing. And of course, your profit and loss as well. But the delta is a very important key factor to really understand the full picture of where your option is relative to the expiration date and what your probability of success is. Now comes the all important question. Should you exercise your rights to buy stock or should you just sell the option contract? Now let's take a look at a scenario here. So let's say that you have a stock, okay, and it is trading at $80. You buy a LEAP call option on it and you pay a price, your premium is $25. All right, so you pay $25 for this contract and an expiration date of 1 year out or 2 years out, let's say 1 year. Okay, well, let's see what happens in 1 year's time. So this is going to be 1 year later. The stock is now at $120. Pretty good. This means that your call option is worth quite a bit of money. And let's say your strike price is $80, okay? So your call option says that you have the right to buy the stock at $80. Well, here is the scenario. If you bought the stock, right? So if you buy, which means exercising your right to buy the stock per your option contract. So that means you are going to buy the stock at the strike price of $80 times 100 because one option contract controls 100 shares. So you are laying out $8,000 to make this purchase, okay? But remember, the premium that you paid has to be factored into this, right? So the premium that you paid was $25 a contract. So the premium total was $2,500 that you paid, $2,500. So if you were to buy the stock at $80, which is $8,000, and sell it on the open market for now $120, you're making a $40 profit on this trade. So now you can sell the stock for $12,000 minus the $8,000 that you paid, which gives you $4,000 as a profit. But remember, you have to factor in this premium paid. So it's really $4,000 profit of the stock minus 2,500, which gives you a total of $1,500 profit on this. So to exercise your right to buy this stock, you would profit $1,500, but you would have to put up $8,000 in order to do so. Now, on the other side of that trade, let's say you have the option contract and you just want to sell it. Well, let's say the premium that you paid is $24 and now the new premium, so new premium is $40, right? $40, for example. $40. Well, let's do the math on this. $40, that means that you can sell it for $4,000 minus the $2,500 that you paid in premium. Okay, so 4,000 minus 2,500 is 1,500. Now, as you can see in this example, and in most examples, when you're finishing the contract and it's expiring, you are going to get the same dollar amount if you do the math, if you sell the option contract or if you exercise your right to buy. But the only downside of exercising this is that you are paying the $8,000 that you have to put up to buy the contract and then sell it. So if you don't have the $8,000, then it just makes more sense to sell this contract. And if you don't want to own the shares any longer, again, it makes more sense to just sell the contract and move on to another trade. So to answer the question, should you exercise or sell the option contract? Well, as you can see, that's going to depend on a few factors. One, do you have the cash needed to buy 100 shares of the company if you wanted to buy that stock? If the answer is no, then obviously you just sell the option contract and collect your profit. If you do have the money and if you want to own the stock for the long run, then you might want to exercise your option. So you are buying it at a lower price, you're in the money already, so you have profit, but you also then want to keep it for the long run. So in that case, you want to exercise the option, own the stock, and then hold the stock. But as you see from the example, on expiration date, your contract is going to be worth the same if you sell the contract or you exercise your right. It just depends on the goals thereafter of what you want to do with the stock, if you want it or not. Now, the ultimate goal would be something like this. Let's say you bought an option contract and it is in the money. Well, you want to then sell it before it reaches the expiration date because you have an added benefit of having time value still left in the contract, which is going to make your contract more valuable rather than just waiting till the expiration date, right? So if your option contract is in the money, you are going to make more money by selling that option contract when it's before the expiration date because not only do you have the intrinsic value of it being in the money, but you also have time value that is added on top of that. So this scenario shows what the profit will be at the end of expiration, but if you sell it before, you have an added value metric that you could add on top of your contract to make more profit. So now let's talk about my personal option strategy when it comes to leaps. So first, let's go back to how I discovered options in the first place. Well, it was through the movie The Big Short, and there was a section in it where they talked about these two guys who made a bunch of money on options, and I'm like, options, what's that? So I did some research and I came across a book that explains exactly how they did it, which is called Market Wizards. It's one of my favorite books. And in that book, they showed the option trade that these two guys made. And so what they basically did is they saw that a stock dropped in price, but the fundamentals had not changed. So what they did is they bought option contracts with an expiration date of 2 years out with a strike price of whatever the stock was before the stock fell. So they picked a strike price for the recovery of the stock. Okay. So they weren't betting that randomly a stock is going to go up to this random price and they're going to cash in some money. No, they saw an opportunity in the market. A stock dropped, they looked at it and they said, well, why did this stock drop? Did anything change in the fundamentals? Turns out there was some bad news about the company, and they bought a strike price for the full recovery of that stock. So the stock went from 50 to 30. They bought the strike price at $50. So if that stock, which was Capital One stock, were to recover to $50, they would have made X amount on that trade, and they ended up making, I think, 20 times their money. They put in $26,000 and they made a profit of $500,000. And that is the power of LEAPS options. And that's sort of what I want to take advantage of. I don't want to randomly speculate on stock price movements. Okay. So the way that I made a lot of money initially with options, these types of LEAPS options, was doing exactly that. During the pandemic crash, I saw stocks just tank, right? And doing a little bit of research on pandemics, how long did it usually take for everything to go back to normal? And the answer that came up was 18 months. It took 18 months for the pandemic to sort of fully go away based off of past experiences of pandemics in this world. So it took about 18 months. So I took a look at that and I said, well, okay, if the stock market is forward thinking, then I could assume that the stock market will recover before this pandemic is gone. So using that thinking, I went ahead and I bought call options on a lot of the stocks that went down quite a substantial amount. And I was betting on the recovery of those stocks. My expiration date, I took it to 2 years out just to be safe, right? So I opened up the app and I scrolled all the way out to the last expiration date that there was just to be safe. And I chose that and I chose a price of a strike price of the recovery price of those stocks. So I was betting that these stocks will recover by the time the expiration date hit. Now, another way that I like to use these LEAPS option contracts is to increase the exposure that I have on my stock position. So let's say that you have $10,000 of a particular stock, and I want to take a small amount, let's say 5% or 10%, and put it into LEAP option contracts. So that means that the stock will appreciate a certain amount, but also I will increase the percentage of profit by having a small percentage in LEAPS options. So if I have $10,000 in stock, maybe I take $1,000 of that and I put them into 2 year out LEAP options with a strike price of at the money, maybe in the money if you want to be safe, maybe just a little bit out of the money. I never like to gamble too much on out of the money options in this particular scenario because, again, we don't have that sort of stock drop that you could have taken advantage of, like in the previous example. But if I'm just holding the stock for the long run, take a small percentage and just try to increase the profits of holding that stock with a little bit of LEAPS options. The third way that I really like to use these LEAPS options is, let's say you want to sell out of your stock because you want to take profits. Maybe you see another investing opportunity. So you never know exactly when a stock is going to stop appreciating in price because it can go up forever theoretically, right? So what I like to do is, let's say I sell a stock. Well, then I would take some profit from that stock sale and I would put it into LEAP options just in case that stock continues to go up. Now, let's say I take 5% of the profit from the stock. Well, I'm taking 5% and I'm betting that on LEAP options. And if I'm wrong on that bet, well, I lose 5% of the profit that I had already made with the stock. But if I am right and I 10x that 5%, well, that is going to translate into a much higher percentage overall on this investment. Best case scenario, that asset just keeps going up and you're still making money on the options themselves. So those are the three types of ways that I like to use LEAPS options as a sort of asymmetric bet to increase my profits. Now, again, taking a step back and looking at the full picture of everything that goes into it, you have your return on investments, you have your delta, your theta, all of these things matter. So I really urge you to study them and understand your option trades before you make them. Now, I would also urge you not to use LEAPS options as speculations or gambling. If done correctly and if you understand your trade, you can really have a safe investment on your hand with little risk but high reward. So as long as you know all that, I think you are ready to dive into this strategy. If you want to learn more about options, you can check out my other videos. Thank you all so much for watching and good luck.